Here is a very common mistake I see many people make. A lot of people simply research various altcoins and try to estimate where might adoption be headed. So they're looking, for example, at the crypto gaming landscape and say, okay, this 1 or 2 crypto games, they are interesting, they might see a lot of user growth. Or you might look into the DeFi space and you might look at decentralized finance, find out, okay, this borrowing and lending platform or this decentralized exchange is starting to get traction. This is the potential project I want to invest in. And that's pretty much where it stops for many. And even if you're right, so let's say you did identify the right crypto game, it doesn't necessarily mean that you're going to make money with the token off of that crypto game. Unfortunately, far too often, I believe that the topic of tokenomics is being overlooked. So tokenomics is simply an umbrella term to describe how is the supply of a token developing over time. And there are 3 major factors that I believe impact tokenomics a lot, impact supply a lot, and thus also the price, thus the return for the investor and the token. The first thing to always look at is token unlocks. It's vesting periods. It's seeing how much is actually the founder team and the early investors, how much are those kind of people going to get over time in additional allocation. So this is what usually happens, right? In order to develop, say, a crypto game or a DeFi platform or anything more complex, you need to have the resources, you need to raise money to pay, for example, for the programmers. So you need money beforehand. You might need to raise this from professional investors. You then say, okay, here is your token allocation, but you're not able to sell this instantly. You might have to wait a year or 2 in order to then get this allocation unlocked, to get your tokens vested, to then be able to sell once the project has already grown, once the price is already up. So that's a very common way to bootstrap any kind of project, and that's in general not so good if you are buying at the top when all those early investors dump on you. Very often token unlocks investings are transparent though. So in the documentation or websites such as token.unlocks.app, on various websites we can actually see when will there be upcoming token unlocked? When will the early investor, when will the early VC be able to sell? Knowing that is very, very useful because once the unlock happens, the selling might not happen instantly, but it could happen over a prolonged period of time after the unlock. And that's potentially the time where you don't want to necessarily be too allocated in the project if the project isn't growing that much anymore, right? Because a lot of the relative growth in demand happens at the beginning. But then once the unlock happens, maybe the growth, relatively speaking, slows down a bit, right? Maybe the project doesn't grow anymore by 10% per month, but only by 10% per year. But then all the supply hits the market. And then, of course, there's more supply than demand growth. And that then, of course, depresses the price. So I think it's hypercritical to always look at token unlocks, to always see how is the supply developing over time. If the supply is likely going to grow by 30, 40, 50% in the next 12 months and the project isn't hyper scaling, then this is potentially a red flag and potentially a project to rather step away from. Now, a very similar topic, but a related topic is staking and is locking up your tokens. So what sometimes happens is, and that's also to benefit early investors, it's to benefit the early team, to get them have a very high price to sell off. What happens is the project might be offering a staking program. So they might be saying, okay, just deposit your tokens over here. You cannot touch it for the next 6 to 12 months. And in 12 months, you get more tokens back. You get maybe 20, 30% more tokens back. So you get a very high APY measured in tokens, of course. And you think in the end, of course, that's a good thing. But think about this, how this fundamentally works. What's actually fundamentally happening? Fundamentally, you're putting away your supply, as in the supply that you hold will not be sold for that period of time. Thus, the token gets more scarce during that time period. Thus, the price goes up. When during that time period, there's also a vesting unlocked by the early investors, then they can sell for this higher price, dump on you. But let's say that's not the case. What's happening fundamentally? The supply gets artificially reduced during the lockup period and then gets artificially inflated directly after the lockup. It gets inflated by even more than got reduced in the first place because you need to offer some kind of APY. So what happened, for example, with the PancakeSwap token, right? With the Cake token. The PancakeSwap decentralized exchange offered a staking program, and you were able to lock up your tokens for a year. If you locked up your tokens for a year, you got back roughly 80% more tokens after that 1 year. But what happens then after that 1 year? Within this 1 year, the price of Cake relative to other cryptocurrencies appreciated as expected, as people were staking more and more of their tokens. But 1 year after the introduction of that staking program, the price of Cake completely collapsed. So a lot of people, of course, got all those Cake tokens back. They don't want to hold Cake necessarily anymore. They want to diversify into other projects. They dump potentially their entire position, maybe the reward that they got, whatever it is. They tend to sell Cake. The price of Cake goes down. So what's happening with a staking program is that initially the price tends to do very well, and then once the staking program ends, the price tends to crash. So what's very important for those kinds of tokens is to find out at what point in time was there a lot of lockup. And how long did those people on average lock up their tokens for? The main problem with crypto YouTube is conflict of interest. Too many YouTubers shill garbage, promote garbage, and fill up their pockets in the background. Not this channel. Instead, there's simply the offer where I share my skills, my perspectives to you, and where I also share direct access to me, where you can ask me any questions. Feel free to check it out. The premium membership link is down below. Very often this kind of data can be found on Dune Analytics. So that's D-U-N-E. Very often you will find a chart, a time series chart that shows this is the amount of staked tokens on a given day. And when you see a spike at a particular day and you know what's the average staking period, then you know on average when those tokens get released again. And when the release happens, then of course the price tends to underperform the rest of the market. I'm always talking about relative valuations here, right? Because of course when Bitcoin goes up, when Ethereum goes up, then all of the prices go up because all of liquidity is going up. But I'm looking here at relative valuation. So for example, the altcoin divided by the Bitcoin price, or the altcoin divided by the Ethereum price. So is the altcoin measured in ETH tokens going up or down? That's the main thing we are concerned with, right? Because we take on more risk by buying an altcoin, and so we want to get rewarded for that additional risk. We don't just look at the general ups and downs of the market. We want to see, do we actually get outperformance or underperformance? Because in general, we can even hedge ourselves against the general market, right? What you could do is you could deposit stable coins on a buying and lending platform, borrow Ethereum against this, and then buy your altcoin with that bought Ethereum, hope that your altcoin outperforms Ethereum. So you can completely cancel out the ups and downs of the market and solely trade the relative valuation pairs, which I believe makes a lot of sense if you don't just want to allocate to the general expansions and contractions of the crypto market, especially if you don't have a very strong opinion on that right now. So we've got vesting unlocks by the early investors. We've also got staking unlocks by the stakers, and both of them can depress the price a lot. The third factor that can depress the price a lot is usage rewards. So this is very typical in crypto gaming. It's also somewhat typical in DeFi platforms. So if you use the DeFi platform, if you use the crypto game and you simply just generate a lot of activity on the platform, then this is good for the platform because it generates fees, of course, but it's also nice simply just for recognition, as in the total value locked, the capital that's locked up in a certain project is going up. This creates more attention. So usage can be incentivized, and that incentive is very often the project's token as well. So there is new allocations to the users of the platform, potentially diluting the price of all the current holders. So what does this mean? It means the following. It makes sense when there's a lot of incentive redistribution to be part of those people that get incentivized. It's very hard to be early in a project and get these kind of vesting allocations. It's not that hard to play the crypto game. It's not that hard to research the staking program. Because what happens, right? Not all of the tokens will always be staked. Not all of the users will always play the game. So the people that actually play the game, or the people that actually stake the tokens, they get the value redistributed to them on expense to all the other holders. So let's say only 30% gets staked, the other 70% doesn't get staked, and there is token dilution happening because the stakers get additional tokens. Then the stakers, they get value transferred from the non-stakers. So the existence of a staking program might not be a problem. The existing of a reward program might not be a problem, but you want to be on the right side of that equation. If there's a tons of rewards that we get distributed and you don't get any of those rewards, that's a problem. If there's a lot of staking rewards that get sent out and you don't stake, that's a problem. If there is vesting unlocks while you have to lock up your staking to a point of time after the unlocks for the early team, that's also a problem. All of those factors are hyper important. So proper altcoin investing is not just a matter of drawing lines on random price charts, it's really understanding the tokenomics. And it's not always that easy because the team doesn't necessarily want you to know these kind of things. It doesn't want you to necessarily think about those things, right? The founder team would never announce, please look up your staking for 1 year because we will in half a year already get our allocation and we want to dump on you, right? This is between the lines. You have to find this out by yourself. Very often we can because all the information is public, but we have to do the research. And it's not just a matter of drawing lines on charts. It's a matter of actually understanding how the supply is developing over time. And so that's why I believe it doesn't make a lot of sense to hold an altcoin portfolio of 20 or 30 tokens because it's impossible to do all that research for all those kinds of tokens, especially since there's new developments, new projects, and new programs that get regularly announced, right? The tokenomics of today might be different to the tokenomics of tomorrow because a project might, say, issue NFTs, and that might bind up a few more tokens. A project might do another funding round, allocate new tokens to that funding. A project might completely restructure their token, right? Might rebrand the token, might launch it slightly differently, right? Sometimes there's these conversions from an old token version to a new token version. There's all kinds of changes, and you can't do this with like an altcoin portfolio of 20, 30 altcoins. You have to do your proper research on every altcoin investment, especially if you hold them for the long term, because most altcoins underperform most of the time. And sometimes they might be outperforming, but there's usually reasons for this. And those reasons can be partially anticipated if you put in the sweat equity, if you put in the hours. With the PancakeSwap token, for example, I made a lot of money with that staking program because we would get 60, 70% APY for the Cake token. At the same time, you could borrow the Cake token on a borrowing and lending platform for 15% APY. So we made a clean interest rate arbitrage without being exposed to the price risks. Once the staking stopped and once we paid back the loan, the Cake denominated loan, and we saw that all of the selling happened from the stakers, then we shorted the Cake token and made additional money with that declining Cake price. So there is a real way to make money with those tokenomics plays, but you have to understand the tokenomics properly. You have to understand this better than the average market participant, because that's in the end what this is all about, right? It's a player versus player game, and you need to understand the rules better than most others. Then, only then you can make money. Feel free to give this a like in case you want to help this channel grow. Feel free to also join our Telegram group. There's a link down below to our Telegram channel. Looking very much forward to chatting with you over there. Cheers.